So my name's Akil. I'm on the Oxford Real Estate Society Committee, helped to organise the conference, and this panel is to discuss affordable housing and specifically can the government's aims and objectives be met, and we're going to use that as a starting point. We're joined by lots of super experienced people from within the sector, and hopefully we can discuss a lot around that topic and then leave a bit of time for Q&A at the end as well. So the format will be a quick introduction of the panelists from myself. We'll then hand over to the panelists to talk about one particular area within affordable housing for about 5 minutes each. And then we'll have a Q&A and discussion at the end. So if you do have any questions as we go through, please use the Q&A function to send them through, and then I'll pick them up and make sure we discuss them. So just to get started, we're joined today by 4 very distinguished individuals. So thank you very much to you all for joining us. Mary Parsons is the Regeneration and Partnerships Director at Lovell. Mary has over 25 years experience in the sector, has been involved in some of the largest housing-led regeneration programs in the UK, worked across both the private and housing association sectors. Prior to Mary's current role at Lovell, she was Group Executive Director at Places for People. Mary was also Commissioner for the government's Building Better Beautiful Commission, and among other roles has a trustee and chair of the Town and Country Planning Association, trustee of Moby, which is an educational charity established by George Clark to promote innovation in housing. We're also joined by DJ Dhananjay, who is Fund Manager of UK Affordable Housing at CBRE Global Investors. Also very experienced with over 20 years in the sector, establishing product strategies and delivering investment portfolios, working both the private and public sector. DJ's been involved in the delivery of over 5,000 housing units across multiple housing development and regeneration programs. At CBRE Global Investors, more recently, DJ established a UK social impact fund, investing in affordable housing for their global client base. And prior to CBRE, DJ served with English Partnerships, which is now Homes England, where he funded and developed mixed-use schemes focused on national housing and regeneration programs, such as the First Time Buyers Initiative, Surplus Public Sector Land Initiative, and was also involved in community land trusts. We've also got Tom Bloxham with us today, who is chairman and founder of Urban Splash, which is an award-winning regeneration company, has won over 420 awards for architecture, regeneration, design, and business. The company was started in 1993, just 2 men in a shed, working on the first project, which was an unloved building in Liverpool, and is now the Concert Square mixed-use scheme. And since then, Urban Splash have created thousands of new homes and jobs, investing nearly £1 billion into regeneration projects across the country, from Manchester to Liverpool, Birmingham, Sheffield, Bristol, Plymouth, and others. And most recently, in 2019, Urban Splash received one of the sector's biggest ever deals, a 90 million transaction, which saw Japan's biggest house builder, Sekisui House, and Homes England become shareholders in the company. And the provision of affordable homes has been a core pillar historically and in ongoing developments across the country. And these include Wirral Waters in Merseyside, In-Home at Northstowe in Cambridgeshire, Campbell Park in Milton Keynes, and a project with the National Trust in Cumbria. And also Urban Splash has a fund management business, which I'm also involved in, which is increasingly looking at affordable homes as a sector to enter. And last but certainly not least, Ben Denton is the Chief Executive of Legal & General Affordable Homes. Prior to joining Legal & General, Ben was at Sovereign Housing Association, which is the 6th largest housing association in the UK. And whilst there, delivered a development programme of 1,300 homes a year with an annual budget of around £250 million. With over 30 years of experience across the residential housing and real estate sector, Ben's worked in a number of other roles, including as chair of Westminster Community Homes and deputy chair of Thames Valley Housing Association. And so with those brief intros, I'm sure our panelists can talk a lot more about their experience than I've been able to summarise there. But Mary, if it's okay, would you kick us off with a bit of a discussion around the supply of affordable housing currently, why it's so important, and are we doing what's needed?
Great, thanks. And yeah, I'm going to do a very quick sort of scene setter with a bit of not just looking at the supply, but also the demand for affordable housing, and I think, you know, why it has got such an important role to play post-COVID. I think we are at a point where government intervention, we've got the highest investment level into affordable housing than we have for a long time. There's £12 billion committed overall. Homes England has a £7.4 billion programme between April 21 and March 2026, and that's aimed at delivering 130,000 new affordable homes outside of London, and there's a further £5 billion within the GLA and London. The government's relaxed the borrowing caps for local authorities, so there's the potential to start to think about new council housing as well. And if we look at the performance in the sector, in the 12 months to March 2020, we haven't got the latest figures yet, there was 57,000 affordable homes completed and a further 68,000 started. That was up slightly on the year before and up over 13% on the year prior to that. So the 240,000 homes we delivered in the year, around 23% were affordable, which sounds really, really positive. Of that, rental affordable homes is 2/3 of the completions and over half of the starts, with shared ownership and intermediate the balance. But that's a decrease in trend. In 2015, 3/4 of all new affordable homes were rented. If we look back to 2011-12, social rent, what you class as old-fashioned social housing, was the most common tenure. It was replaced by affordable rent, linked to market rents and local housing allowance. And social rent now is only allowed in specified local authority areas where there's real affordability pressures. Of course, we deliver through grant-funded programmes, but also through Section 106s, and around half's delivered through Section 106s. Yet, if you look at the statistics, very few local authorities actually achieve their policy position for delivering affordable housing through Section 106s, but it still is an important role. So everything sounds really positive, but we still have a massive undersupply, and the shortage doesn't seem to be improving despite all of the investment into it. So if we actually look back at the causes why, I suppose the turning point was when Right to Buy was introduced in 1980. There was just shy of 2 million council homes sold off, Margaret Thatcher's flagship policy, and we lost well over 1 million of those as a net loss to the sector. That quantum of affordable housing has never been easily replaced, and even now we're bridging that gap. And of the Right to Buy homes, it's estimated that over 40% of them are actually now in the ownership of private landlords, and quite often rented to people on housing benefit. So there's been a sort of double government subsidy within them, but it has helped people into home ownership. But it stands at November last year, the estimate of how many people on the social housing waiting list in this country, it was over 2 million people. So you can sort of see a direct link there of where we've lost capacity in the sector. And the National Housing Federation and Shelter said that we'd need to be delivering 340,000 homes a year for the next decade, of which 145,000 of those each year must be affordable, and 90,000 a year social rented homes. So we're nowhere near at that kind of level. And I think the biggest part of the problem really for a lot of people is they can't access the housing market. They can't access home ownership, which I'll come back to. They're living in unaffordable rented accommodation, and housing's affordable if it's less than 1/3 of your income. And you can see an awful lot of people currently are paying a lot more than that. Doing some work in Croydon a few years ago, they said that at that time, almost half of all of the homeless cases that presented to them were working families that just could not access suitable accommodation. And I think as we look at the sort of impact of COVID, that's only getting worse. The Guardian recently said that COVID frontline workers are now priced out of home ownership in 98% of Great Britain. You know, so despite all of the government investment, we are still getting increasing unaffordability. And we do have a government, current government is very much focused on home ownership, housing aspiration and not just need. And a lot of their market interventions are pointing at that. But we are now looking at things like shared ownership. You can have an income of £80,000, £90,000 household income in London to be eligible. And that sort of suggests there's something completely dysfunctional still with the housing market. You've still got average house prices of 7 times median incomes. You go into London, that's average of 12. You go into Kensington and Chelsea, it's 27.5 times average income. So it is, you know, 290 of 361 local authorities are now less affordable for local residents than they were a decade ago. So as well as increasing supply, and I know, you know, Tom, DJ and Ben's going to look at how we construct and how we invest and we bring new entrants into the sector, which we really need to do to scale up to this challenge. I think for me, one of the biggest things we need to grapple is the eligibility and allocation of homes, because so many people now rely on affordable housing because they cannot access the housing market. And I think, you know, there are the economic and social impacts of unaffordable housing on health, on well-being, on economic performance. And I think if you go back to when we invested in council housing, it was seen as an aspirational tenure for working families. It was a step up. It wasn't the tenure of last resort where you ended up if you didn't have a choice. And I think if you roll back even further and you look back to, you know, Bourneville, Saltaire, you had the philanthropists actually had a deep economic purpose. There were large employers that understood if they invested in homes where their workers were close to where they work, where their families were healthy, you know, it had an economic benefit for them. You can see now actually that's coming back. I'm on the board of the University of Cambridge's property board for Northwest Cambridge and their investments. They're making a huge investment into key worker accommodation and homes for people that work at the university, but also to attract the talent pool, because that disconnect between the housing market and the economic opportunity will really hold a lot of areas back. And I know a lot of others are doing the same. So I think I just conclude by saying, you know, affordable housing, it has to play a really big part in post-COVID economic recovery, because it is such a fundamental part of the well-being of our society, really. So on that note, Akhil, I'll hand back to you.
Thanks very much, Mary. That's a really helpful introduction into the sector. I've jotted down a couple of things which we can come back to. But Tom, I think it would be great if you could tell us a little bit more about the delivery of affordable homes. And we have a short video to play just before you get started. So if we could magically make that appear, that would be great. Over to you, Tom.
Uh, Thank you, Akil. That was great, and thank you for inviting me. It's great to be here in Oxford. I wanted to tell you a story about why affordable housing is of interest to us as a private developer and what we are doing to build more affordable housing. And MMC, or modern methods of construction, or modular build, is a big part of it for us. And you saw on the film there a bit about our factory. And the reason we're doing that is twofold. One is to increase production of housing, and we all know about the skill shortage, and actually it's about bringing more capacity into the market and alternative capacity. Sekisui House, who recently invested in us, actually build 40,000 homes a year. That's more homes than the top 4 UK house builders, and most of those in factories. But we also believe using industrialized processes can bring down the cost of housing. If you look at most products, like your telephones or your computers that you're on this, or your televisions, every time you buy a new television, it's actually bigger, better, and cheaper than the last one you got. And yet our houses are more and more expensive, no cheaper, and arguably worse. So we think MMC can help reduce the cost of housing in the long term. And a bit like Jeff Bezos at Amazon, I'm passionate about making our homes more and more affordable for more and more people. So one way we do that is the cost of manufacture through industrialization. The other way we do that is by working with landowners who are sympathetic to more affordable housing. So we're working in partnership with many homeowners, like UK Government for Homes England, like local authorities up and down the country, and like charities like the National Trust, who also share our aims and ambitions. We're also really interested in different ways of financial modelling and different tenures. And we work with a lot of housing associations like Great Places and Places for People. But we're also interested in developing new tenure types. We have shared ownership, social housing, affordable housing. I think what's interesting in the UK is in the housing, you tend to have for sale homes in one part, the affordable housing, social housing on the other side of the railway tracks, and PRS on a separate side. If you compare that, for instance, with cars, if you buy a car, if you're rich enough, you buy it for cash. If you're a normal working person, you get on contract hire or lease. And if you're unlucky enough to be disabled and the state thinks you deserve some subsidy, you get disability, but you end up in the same car. And so we're really interested in different models where we can have multi-tenure and in placemaking, like the place you saw in the video. And I firmly believe the places are better where they're mixed tenures. So we're working hard of getting terraces of houses, like you can see the scheme behind me, and some for sale, some for rent, some shared ownership. And for us, that makes better places. And it's also not just about the housing, but it's about the placemaking. And where we live and the quality of our life, as Mary was saying before, the quality of the housing makes a huge difference. All too often in these sorts of conferences, people are talking about making more and more units, whether there's a public sector or the private sector. And we have to remind us all, we're not making units, we're making people's homes. And the quality of those homes have a fundamental effect on people's lifestyle chances. So we're passionate about making our homes more affordable. We're passionate about making great places. And we only do that in partnership. And it's probably no surprise that most of us on the panel have worked together, usually in a few different lives, and we'll continue to work together. And so it really is, for us, all about partnership working between the public sector, between the private sector and the voluntary sector to produce more really high quality housing in all tenure types. Thank you very much, and I'll hand back to Akil.
Thank you, Tom. Again, really interesting. So if I could hand over now to DJ to talk a little bit, now we've set the scene in terms of the need for affordable housing, how it can be delivered, who pays for it. So DJ, it would be great to hear a little bit your perspective on attracting global investors into the UK affordable market.
Thank you, Akil, and thank you for inviting me to this panel discussion. I would spend the next 5 minutes just looking at how the private sector capital has been coming into and investing in delivery of housing. And that is just not a new phenomenon or a new way of investing and delivering additional housing. So just over the last 3 years, if I look back, residential was not the top pick for many of the investment houses. But what we have seen today, 3 years later, it alongside industrial tends to be the top sector for investment for most of the private sector, institutional real estate capital. Over this period, what we hear today is that there's nearly 40 billion odd of capital available to invest in the residential sector altogether. Of 3 years ago, there was only a couple of billion, predominantly into student housing and somewhat retirement living. The latest survey that I have seen, one of them suggests that half of the capital that was previously looking to go into the private rented sector, actually half of the capital is looking to invest its and acquire assets in the affordable housing sector. So what we have seen is a tremendous interest in delivery of social and affordable housing. And this number keeps on growing on a quarter by quarter basis. So let me go back slightly into the history of social housing and how it was delivered. We've just come to the 500th anniversary of the oldest social housing asset in continental Europe. It's in Augsburg, called the Pförgerei. It was built by a private family. The quirk of it is, if you live there and manage to get a unit at the Pförgerei, you're still paying less than €1 a year. Now, investing in housing, that's why it's both quirky, complex, and interesting. In more recent history, if I come back to the UK, private sector was delivering housing in the UK, as Mary alluded to earlier. It all started in the late 19th century, somewhat in the form of garden cities. It was housing built for the working classes. And then it sort of transformed into the establishment of a number of model dwelling companies in the early part of the 20th century. Now, what I found very interesting between then and now, 100 years later, is those industrial dwelling companies were looking to deliver a 4% income return. After delivering good quality, better housing for the working classes, today, the international capital, the domestic capital, still wants the same level of income return out of housing. I'll let you resolve that one at this point in time. Then we see that, and I think it's very easy to deduct out of the history of housing and housing investment, that this renewed interest in delivering social and affordable housing is nothing new. It is really bringing equity back to what is the single largest real estate sector. It was an institutional asset class. It is again becoming an institutional asset class. And there are many reasons for this as to why the institutional capital is looking to invest in social and affordable housing. One, I believe it is to do that the asset benefits from intergenerational occupier dynamics, because it leads to high occupancy and better rent collection rates. Demand has substantially outpaced supply. And with each passing year, as we deliver less and less affordable housing against the demand targets, there's more of an acute need. After this latest recession, I think there will be a greater need for affordable housing, as those households who are in the lowest income quartiles are the most stretched. The asset class demonstrates very clear characteristics of delivering stable income distributions with a level of protection against both inflation on the upside and inflation on the downside. So it is what a long-term investor is looking for. It provides an ability to match pension fund liabilities, as it does match the commitments and the liabilities of insurance companies. So there's little surprise that the private sector capital is looking to come to the UK, which is one of the more transparent markets from a policy perspective, and invest in this sector. The other side to this at the same time is that traditionally over the last 30 to 40 years, social and affordable housing was being delivered by the registered providers. It was at the back of government funding. Over the last 5 years, government funding has tapered down, so there's lesser capital. The level of debt in the sector has risen over the years as registered providers went out to the capital markets to raise debt. But more importantly, what's happened in the last 24 months is that the focus today for whatever capital was available has been on delivering homes to the Future Home Standard, there are decarbonization targets, and there are building safety policies to be met. And what that's done is that the capital which was previously earmarked in various housing providers' sort of business plans or 5-year business plans is now channeled towards capital expenditure rather than delivery of new housing. I will finish off with this, but I've been involved and looking at some early modeling on asset allocation. And as institutional investors, you look at how much of your capital should you be exposed to a certain asset class or an emerging asset class. And some of the initial results suggest that 5% allocation could achieve improved returns in a mixed asset portfolio without taking additional overall risk. Now, that is strong empirical evidence for global capital seeking to invest in the UK affordable housing sector. And what we have found is over the last 3 years that there is significant capital and greater number of conversations to be had with a larger number of clients who are interested in coming to the sector. So in my view, this opportunity to invest in housing, development, regeneration, modern methods of construction and technology, which delivers to the needs of people, is going to be the next big asset class within real estate within the next 10 to 20 years. And I'll finish off with that. Thank you.
Thank you very much, DJ. And just to pass on then to Ben, I think one of the areas that you've been focused on quite heavily at Legal & General Affordable Homes has been on the experience once people are in the homes and the technology that you're using to manage those. So, you know, now we understand a bit more about the need for affordable housing, how it can be delivered, the sources of capital that can provide it. What could you tell us a little bit about the experience of living there and how that's evolved and how you go about it?
Yeah, thanks, Akhil. And it's great to be here this afternoon. So thank you very much for inviting me. So just picking up from DJ. So obviously I'm Chief Exec of L&G Affordable Homes. So we are an institutionally owned registered provider. So we operate in a marketplace which is generally populated by not-for-profit affordable housing providers, but we're one of a sort of small group but growing group of organisations that are institutionally backed and develop and own and operate affordable housing. And I guess one of the concerns so the legislative framework for institutional funding or private ownership of affordable housing came into effect about 10, 12 years ago. And it's only really over the last 4 or 5 years that the sector has started to emerge and grow. And I guess, you know, one of the interesting questions that comes across my desk from time to time is, I guess, a general concern that is it right or correct for institutions to be operating in the affordable housing sector, which as DJ said, it was traditionally a sector that was populated by philanthropists, and then the public sector and then the voluntary sector have populated the marketplace, and now institutions are starting to fund in the marketplace. So that's one of the questions: is it right for institutions to step into this marketplace? And as DJ's highlighted, there are some headwinds affecting the sector, which is the need to invest to deal with fire safety and greening of the stock, which mean that there's not as much housing being delivered potentially, and then Mary's point that there's just not enough affordable housing being delivered. But the second, more, I guess, concerning issues that we hear is this question of whether will profit distributing organisations skimp on housing management and deliver a lower level of customer service to try and drive the profitability of their business. And so it's that I really want to major on today. So just a bit about L&G. L&G was set up in the 1830s. It has 10 million customers. And that's a really important aspect, because when the group board of L&G contemplated setting up an affordable housing business, the most important thing for the group board that it stressed to the organisation and to me in setting it up was that we cannot ever do anything that undermines the trust and confidence of the customer in the L&G brand. So it wasn't about whether returns would be delivered or whether we were going to grow as quickly as we thought. It was all about how were we going to build and operate a really successful business, successful in the sense that we deliver really great levels of customer satisfaction. So right from the beginning, the requirement to deliver really good levels of customer satisfaction was a non-negotiable. When we then look at the sector, what's the customer experience in the sector? And clearly government has shone a spotlight into this space, given the awful events at Grenfell and the lack of trust and confidence between residents as customers and their landlords, and the need to improve customer experience in the sector. So when we look generally at we look at the sector in terms of customer experience, and your average affordable housing customer will be delivering a service from their landlord and seeing a net promoter score of something between minus 15 and probably +7, depending. Those are the general scores over the last year. And just for sort of context, net promoter scores goes from -100 to +100. So if every single one of your customers gave you 10 out of 10, you would get 100. As you go down through the scores, as 8s and 9s are still positive, and as you go below 8s and 9s, you start to get into neutral or detractors. So the whole focus of net promoter score is to have as many promoters as possible and have as few detractors as possible. So you're getting up to really, really positive areas. So as we set up the business, the challenge for us was how do we deliver really, really great customer satisfaction when the general experience in the marketplace is quite poor and quite challenging. And I guess we're in a, when we look at the sector, the challenges are poor quality data that's owned by landlords. So therefore, as a result, it's difficult for a landlord to respond efficiently and quickly to a customer if they don't have the information at their fingertips to be able to address the issue. The second point is a lack of visibility through the supply chain. So if a repair order, which is the most important thing that customers normally transact with their landlord, if you don't know when a repair order is going to be transacted or by who, and whether the person is on the way or whether they're not, then of course in a modern world when there's so many services that you can see in real time whether you're being delivered, that's an unsatisfactory set of circumstances. And the third point was how do we create a business that we've got a great culture of ensuring that we're constantly looking at when a customer is not 100% happy, and how can we work in a way to take that dissatisfaction up to satisfaction. So what we're seeking to do is build a business where we tie together the people, the technology, the processes within with great quality data to deliver a frictionless operational platform. And effectively our business is a fulfillment platform. So we link together institutions providing funding, customers, our supply chain partners, and us as a manager. And so we're on a journey to get to where we need to get to, but the really interesting challenge is that is going to either allow us to get there or be a bit of a challenge in the process, is being absolutely fastidious about data. Because if we don't have the right data in the business at the right time, it becomes really, really difficult to operate a digital frictionless business. So just to close, what's our experience been to date? So as I've mentioned, the affordable housing sector generally delivers between about -10 and depending on when you measure it, between -10 and +10. I think the sector is about about -10 at the moment. Just to put it in context, First Direct in the last survey delivered 85.5. Octopus was 82, and our business at the moment is operating at between 77 and 88. So it puts us in the top, so this is out of 400 organisations. It puts us in the top, roughly speaking, in the top 5 to 10%. But I'm told our challenge is not about getting a great score, it's about maintaining consistently a great score. Picking up one of Tom's points, what undermines our score at the moment, and actually it's quality of homes handed over. So that's why for us as well, but the delivery of modular housing, like the work that Tom's highlighted, is really, really essential for our business, because it takes customer satisfaction to a higher level with lower levels of defects, and overall will deliver great sector leading levels of customer satisfaction. So thanks very much, Akhil.
Thank you very much, Ben. So I just have a few questions based on some of the comments that our panelists have just made. If anyone else has any other questions, please feel free to send them through as well. But Mary, one of the points you were discussing was the level of supply and the need for affordable to be 30% of an individual's income. And I guess one question that I'd be really keen to hear your opinion on is that definition of affordable, and how it's evolved over time, because I think one of the points that DJ talked about was that evolution and the history of the sector. But do you think that affordable, in the way it's defined in planning requirements, in targets, is right and is effective, or should it be a bit more subjective and more localized? Over to you.
I mean, I think it has to be based on a local understanding of the housing market, where average incomes and so on. I think, though, we end up defining affordable housing too rigidly, in the sense of a lot of it ends up not being affordable. If you look at shared ownership in a lot of areas, and if you look, Ben mentioned about Grenfell, but things like the cladding issues currently, because the total cost of housing, it isn't just the sort of rent and so on, it can pick up service charges. And if you pull someone, for example, into shared ownership that's a marginal homeowner, that it's the most they can afford, they're incredibly vulnerable to any sort of shockwaves that might hit on the maintenance side. And I think where the government's really on shared ownership now saying, well, let's try and drop the equity share down so more people can own down to 10% of a home, you have to question whether that's the right solution for them. So I think it does need to be more locally responsive. And I also think it needs to link more closely with the economics and the employment offer. I can see it in a number of areas where if you just put, if you like, traditional Section 106 affordable housing, it will go to people at the top of the housing needs register, which is absolutely right. But if you're trying to attract employers in, and they need to see where their workers are going to live, they know that they're not going to do that. So there's an awful lot of people that are squeezed out of both ends of the housing market currently, and I think that's just getting worse. So focusing on that bit in the middle, and as Tom was saying about thinking a bit more creatively about tenures and the affordability, and looking at things like the car market and so on. Other markets have responded to it. We just class and attach a tenure to a home, rather than actually looking at how an individual accesses that home in the most affordable way for them.
Right, and you've clearly worked with a number of developers and deliverers of affordable housing. And do you think that for the typical developer, house builder, that this sort of stuff is on the agenda as well, or is actually the fact that a Section 106 kind of quite easy to understand affordable requirement means that it's easier for them to get on with schemes and deliver more houses than they otherwise would do?
I think it's interesting with the proposed planning reforms actually, and how they look at things like viability tests and so on as well. Affordable housing tends to be the squidgy bit in a viability test that gets negotiated out. You could debate, that could be a whole debate in its own right, but I think just sort of picking up what Tom was saying about looking at affordable housing as an opportunity, I can see it certainly with off-site manufacturing. I see it now that I've moved from a housing association over to a partnership organisation like Lovells. We always aim to deliver more than the Section 106, because actually we take quite a balanced view on risk and reward. So if you've got the certainty of having a percentage pre-sold to whether it's a for-profit or a not-for-profit RP or a PRS investor, actually you're de-risking a lot of it. You might take a lower view on margin, but your return on capital is far more effective. And I think particularly if you throw in things like off-site manufacturing, you've got that certainty of delivery and you're not just relying on market sales to do it. So I think increasingly, a lot of PLCs as well are looking at it and thinking it's a more balanced view. So it's good, we're meeting housing need, but actually from a business point of view, and I think it was something DJ was saying that investors are really looking at, you're moving into more secure environments and markets. And I think it enables you to plan for your own growth a lot more surety without the sort of cyclicality of the market always impacting on it.
Great, thank you. And I think a question's just come through that I'd like to ask you about, DJ. But just before I do, following on from what Mary said, Tom, the provision of affordable housing for, I suppose, you have a developer's hat on, but also a long-term interest in the communities being developed through the fund management business and the fact that the schemes typically progress over a number of years. Is there a benefit to developers of providing more than the Section 106, or is it a kind of, this is the requirement, that's what should be delivered, and then progress and do more schemes? Or, should you be doing more in that particular scheme than is just legally required?
I mean, it's a good question, Akil. And for every affordable house you provide, typically you make less than every house you sell for full price. So there's an economic, with margins being tight, particularly in some of the regeneration areas, companies like Urban Splash are working in, appraisals are always under pressure. However, I do believe there's some real long-term benefits to having mixed communities and to providing a mix of uses in the particular area. We also think that increasingly investors, customers, colleagues who come to work are more and more interested in companies' social credentials and ESG, for the sake of a better word, and what they're doing in the world. And so for us, it's about establishing our reputation, which is more than just the bottom line on profit, but also is about how we make a difference in our communities, how we're changing the world a little bit. And we would hope that we can show a good return. Our residential fund, which although is not an affordable housing fund as such, most of the people in there are paying 20-25% of their salaries, so sub the 30% affordability mark for the average wage. But also we're trying to show returns, total returns up to 10%, and achieving that in the first couple of years. So I do believe fundamentally that actually doing the right thing can also give good financial returns. And I think Mary's examples of the great philanthropists like Bourneville and Saltaire and Port Sunlight are great examples in the last century, or 2 centuries ago, 19th century. And I think in the 21st century, we can try to emulate those by creating great communities and also showing a return to our shareholders.
And I think that question about the returns to shareholders there is really interesting, and one that hopefully DJ and Ben can help us with. One of the questions from the audience is that there's a strong desire by some developers to embed ESG and sustainability into their business model and make themselves and their affordable housing projects positioned as impact investment, but a fear that investors might not be interested because yields are lower. Can you discuss how this is being managed in the UK? And secondly, what are the average yields for sustainable projects? I suppose, are they lower than traditional open market affordable home provision? So I don't know, DJ, if you wanted to answer from an investor perspective.
I could give the short answer, and I'll let Ben elaborate. I always think, and I think this is one of those maxims you learn as a designer, that good design does not need to cost any more than a bad design. It is the same for ESG and sustainability. You need to be conscious of what you're wanting to deliver, what you intend to deliver, and how you deliver it. And it's not a matter of yield being keener or lesser. It is more about the desire and the impact you want to bring about that would lead to the outcomes. Just by way of example, at CBRE Global Investors, we were one of the first to go into various sustainability indices, support ESG, develop the ESG agenda, somewhere starting all the way from 2009, 2010. So we have that history of 10 years. When we launched our social impact fund, really in 2017-18, it was one of the first ones. So, and what we learned out of all our history of experience at CBRE has been, you just need to set out the objective you're looking to deliver and then find the means to do so. And I think there's tremendous support from the investment community and the investors to deliver better and higher standards, which I'm sure Ben will be able to demonstrate very well by what LGIM are doing about it.
Yeah, so it's an interesting question. I mean, so you know, what are returns people would expect to get in this space? And I don't think DJ was was far off there, where he talked about the historic 4%, and certainly the world expects to try and see returns of 3.5 and 4, between 3.5 and 4.5%. What's interesting, and again, I'd agree with what DJ said, is there is a growing weight of institutional funding wanting to come into this space because effectively the cash flows generate index-linked returns, which is exactly what you want if you've got pension fund cash and you're trying to match your liabilities. So for our business, most of our business is funded from society's hard-earned pension fund money, and it's paid into L&G or some of the other pension funds, and a little bit of it goes into affordable housing, and it generates an index-linked return. But it's interesting for us, we've never really set up our business as an ESG business for the purpose of saying it is an ESG business, but we are passionate about all of the aspects that deliver ESG. So for us, how do we get to being a net zero carbon business in operation by the end of next year, which I think we're pretty much on track to do that. How do we accelerate our journey towards net zero carbon homes? So at the moment, about 95% of our program of 5,800 homes at the moment are EPC-B. We've got a development program of about 1,100 directly delivered homes, and about half of those are EPC-A, which so we just think, and so we are writing our ESG report this year, and then our ESG framework for the second half of the year, because we sort of see scope to accelerate work in that space, because it's possible and it's necessary as well. So I guess as we've set up the business, we see ESG as being a really, really important component. But the most important thing is back to DJ's point, that's just what we do on a daily basis. How do we build a future sustainable business that is the future state of where the sector can be, so that the rest of the sector will hopefully copy and accelerate, and will accelerate the pace of change right across the sector.
And it seems like there is definitely then institutional appetite for not just the affordable sector in the UK, but also to do it in the right way, and not just cranking up supply, but also mindful of quality and environmental impact there. So I suppose my question, given also that a number of our panelists have had experience both in the private sector, but also with a public or housing association hat on, is there anything that the government could do in order to, I wouldn't say it's a trickle, but to turn institutional investment in the sector from a trickle to a torrent, or really open up the floodgates and accelerate the provision massively? Are there any initiatives that you can think of that would be particularly helpful?
There is a weight of institutional funding that it is possible to scale up. it's very, one of the challenges with the sector is there are barriers to access to become a registered provider, which is not a small undertaking. And that is, and the regulatory framework was never really set up to contemplate funds operating in this place. But I do think there's an evolution. You know, the regulator is listening and understanding and wanting to open that up. The really funny thing is the changes that government needs to make are tweaks rather than fundamental changes, because it's fundamentally it's all the tweaks that exist for the not-for-profit players, but there are a set of barriers that are put in place with institutional players. So if we operated on the same level playing field as not-for-profit organizations, then it would be a lot more straightforward. We'd still have to pay our tax. You know, we're tax-paying organisations, so it's not expecting any of those things to be moved. But they're all very slight tweaks, and so that's the engagement we're having with government at the moment. Back to your point, Akhil, is how do we turn the trickle into a torrent?
And Akhil, if I maybe just sort of, it might not be a direct response, but something to bear in mind for every L&G who's directly investing and developing and owning and being a landlord within the sector, the big institutions and so on have funded the delivery of social housing for many years. Picking up DJ's point about the reduction in grant, if you actually look at the balance sheets of the large RPs and how they actually source their funding and their cost of finance, you know, they have benefited from that institutional investment as well in various forms and for a long time. So I think, you know, that wall of money, it's finding its way in different ways. It's generating, whether it's through how RPs are accessing bonds or whether it's through directly delivering as well. And so I think when the government's looking at it, it's looking at it from all directions. There's been a big debate within the housing association sector for a very long time about bringing equity directly into the sector, which has always been sort of kept at arm's length. You can do it at a subsidiary level, you could do it in a joint venture or whatever. But things like the treatment of historic grant on housing associations' balance sheets, there's been a long debate about whether you could free up an awful lot more capacity to deliver more affordable homes. So I think, as Ben says, that there's some fairly small scale tweaks that could remove some of the disincentives for new entrants to the market, while still keeping a very strong regulation within the sector, which is essential. But I think there is a sort of bigger picture thing about just how much capital the large housing associations have drawn into the delivery of affordable housing over the last few decades, and it is phenomenal if you totted it up.
Thanks very much. Tom, you've been picked on here a little bit. So the importance of mixed tenures and mixed communities, and the houses behind you and the ones we saw in the video all look great and really appealing, but they also all look very similar. Have you explored any options to increase the kind of level of diversity in a neighborhood by looking at what you can do with the facades and construction types?
Yeah, I mean, very good question there for Michael. And it's true that to MMC to be efficient, you do need a lot of repetition. And it's like in car factories. A car factory doesn't build a Land Rover one week and a Mini the next week. It either builds Land Rovers or Minis. And likewise with our housing factory, we want to build the same stock all the time. There are some varieties we do. You know, you see some 2 stories and 3 stories behind me, and also all forms of different cladding. So we can clad these in slate, in wood, in brick, in metal, in any material you like. But I'd also sort of argue the point that actually repetition doesn't necessarily lead to poor design. An example I would use was the ubiquitous Georgian townhouse, which we see in all our towns and cities. You know, double-fronted Georgian brick symmetrical townhouse is beautiful. We love it. It's in London, it's in Manchester, it's in Bristol, it's in Liverpool, and some of the most highly desired streets are like that. And what we're really trying to do with the house behind me is make a reinvention of the Victorian terrace. And again, we see these in all our cities and very successful, and they've lasted hundreds of years. And what I would say is it actually doesn't really matter The house builders call them gob-ons, where they actually make everyone slightly different with a little bit of a balcony or a different color or a different finish. To me, that's not important. What's important is a fundamental design. So for instance, all the structure in our houses is in the outer walls, and that gives you total flexibility how you arrange the house. We have high ceilings, much higher than most new build housing. We have big windows. So it's these fundamental things about high ceilings, big windows, and the flexibility that I think are really important. And I think in many ways will create a much better streetscape that actually is about people, is about pedestrians, is about giving back something to the streetscape, rather than an endless variety of new build housing in cul-de-sacs, which are car dominated. So for me, it's more about the placemaking and the style and the inherent design, rather than necessarily the variety.
Perfect. Thank you very much. And we have one final question, which it would be great to just get some brief thoughts on, and then we can maybe leave a couple of minutes early so that people have time to get where they want to, or a quick loo break before the next one. And that is institutional investment in affordable housing has emerged relatively recently. How have you got comfortable with the potential long-term capital expenditure exposure, and how do you underwrite an exit in the long term? So perhaps more focused on Ben and DJ.
I should have a quick go at that. So I think it's a really interesting question, because being a bit of an anorak like me, so there's a really well established framework for what life cycle cost on long-term homes. So that's not really it's not really a risk, and it's priced into the acquisition of assets. What is really interesting is that actually homes will need to be retrofitted at some point over the next 10, 20, 30 years, where the cost of the retrofit is going to be greater than the long-term allowance in terms of cyclical works or cyclical activities. And why is it that the valuers have not yet clogged onto the fact that a home that is EPC-A or a hair's breadth away from net zero carbon should be worth more than exactly the same home that's an EPC-B or a C home? So that is the really interesting question, and that will, in a way that I would hope that will then drive better decision making, particularly in the affordable housing sector, for institutions to want to buy higher performing assets, because they're saving the risk of that retrofit cost later on in the process. So it's a really, really interesting area that the sector has to evolve and step into that space and start to understand it.
I think Ben's covered most of what I would have sort of responded to on this one. I suppose the key, as always, is understanding your rate of depreciation on any asset. And that really drives from understanding the build you're buying at a point in time. Because what it does is that drives your on-call maintenance, cyclical maintenance, and long-term maintenance. And then you factor that in your underwriting. The sector it's fine. That is the private sector capital that is relatively new in terms of investing in affordable housing. But the affordable housing sector in its own right has got a vast set of information points that one could draw upon. So, but it takes a bit. That's why it's somewhat a niche sector to invest in and operate in. But it is highly underwritable. And one needs to go in with eyes open and effectively understand the total level of depreciation and the return they want.
Great, thank you. Very helpful answer. So I think that's all we've got time for, but thank you very much to all of our panelists. I found that extremely interesting. The attendees didn't drop off as we were talking, so that's always a good sign. And thank you for joining us at this OxRes conference. Hope that you can join us again next year. And there are a number of sessions on tomorrow as well, so hopefully you find those interesting. But thanks all. Thanks, Tom, Mary, DJ, and Ben.
Brilliant.
Thanks,
Thank you.